Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
I'm here with Colin White, the president and CEO of Verecan Capital Management. I'm going to ask you about the meaning of Verecan later on, but I want to talk about markets first. And in your view, we are at an inflection point. Tell me about that.
Normally, we're at some form of an inflection point, but this one is kind of interesting. We've been watching the confirmation bias play out over the last couple of weeks, where the bears and the bulls are both declaring victory. You know, we've seen some slightly weaker jobs numbers come out, and the bears are saying, "See, I told you so. It's going to get worse." And the bulls are saying, "See, it's not going to get that bad." You know, so it's really interesting to watch both sides claim victory at the same time. There's more and more indications that we could be looking at a soft landing. I wouldn't count on it because things can change in a hurry. We sometimes underestimate what geopolitical things can happen that can disrupt short-term trends for sure. You know, again, Vladimir Putin's body shows up in a ditch. You know, we have a new rodeo. If Iran attacks Israel, we have a new rodeo. And, you know, all of those things are going to supersede any economic indicators in the short term. But having said that, economic indicators do seem to be have gone in the right direction. You know, we wait for the next data point to see if they're going to continue to go in that direction.
Mm-hmm. We got some inflation data this week. The producer prices were below estimates. The consumer prices today were pretty much bang in line. Is the inflation fight over and has the Fed won, or is there still danger there?
Well, it's interesting because we were looking at this since the onset of inflation that the Fed missed and reacted late to, and then ran quickly into the room and said, "I got this. I'm going to fix it." Now, there is absolutely an argument to be made that some of that inflation was just temporary, and it was very specific to the time, and was going to gradually unwind itself over time, as these things tend to do. It hits with a bang, and then gradually it weeds its way out. Now, I think the scholars will debate for a long time whether it's the Fed that caused inflation to come back under control or just naturally drifted back into control. I can say they're going to claim the victory, whether or not they deserve it or not. I think it's going to take a lot more study to really determine, and I think it's going to be a matter of opinion. You know, when you see a shock to the global economy like we saw, shocks cause things to happen. Now, what the root out of it is, it's sometimes it's just time. But what I do like is that the Feds, all of the global Federal Reserves have had an opportunity to increase interest rates, which means they now have bullets in the gun. For a long time, they didn't really have their number one tool to stimulate the economy. They didn't have the ability to drop interest rates. Now they do, which is probably the most direct way to change market sentiment if things do go sideways. So we went through a long time where they were fighting with both hands tied behind their back. I kind of like that for sure, which gives me more confidence that we won't see anything really protracted on the negative side, because again, they have the opportunity, they have the ammunition now. So I'm going to call it a win.
Okay, fair enough. What do you make of the argument that, people can point to past cycles and the infamous 2007, 2008 cycle? When did Bernanke start raising rates? Or maybe Greenspan did even. But rates then peaked out, not quite where they are now, but they were in the 3 or some percent, right? And the Fed had a lot of room to cut then too, and quickly had to. And it may have helped, but it wasn't able to stop the train from going off the tracks in a major way, was it?
Well, the malfeasance in 2008 was of an epic proportion. The fact that more people aren't in jail still astounds me to this day. We're dealing with a completely different animal here. You're dealing with an existential impact on the markets that wasn't really based on any malfeasance. It wasn't based on fraudulent activity. It wasn't based on the epic nature of what happened in 2008. This is more of a natural occurrence.
Hmm.
So I do think that they are fairly dramatically different. But there is a similarity that, again, the Fed's always, no, sorry, not always, the vast majority of the time are late to react. And, you can gauge whether or not they react well or not, but they do have a pattern of being late to react
Hmm.
and either over or underreacting. But it's difficult. One of the members of my team uses the analogy if you got a pot of boiling water and you want to bring it to room temperature, you start dumping ice in it. When do you stop dumping ice into the water? Like, if you dump in too much ice, it's going to make it cold, right? So they do have a very difficult game, and it's a very dynamic environment. Information flows at an amazing pace, and market players are more sophisticated than ever. Capital is traveling around the world faster than it ever has, so they have a tough game. So I don't think 2008 has a whole lot to teach us about what's going on now, other than maybe the Fed does tend to be late to react, and it's always difficult to figure out whether it's the Fed acting that's causing what's going on, or just the other things playing out in the market. Like, we're taking a look at earnings numbers that seem pretty good right now, and the price earnings doesn't seem out of whack in the market. So I mean, none of this is in a vacuum. Like, we
Hmm.
always point to what's the Fed going to say, and that's what's going to drive the market. Well, no, there's 2,000 data points that people are
Hmm.
looking at on any given day, and they're looking at it over different time horizons. The Fed does play a big role in it for sure, but to say they're omnipotent and they're going to set the direction of everything. I mean, the expression "don't fight the Fed." I wouldn't bet against them,
Hmm.
but I also wouldn't give them full credit for absolutely everything that goes on.
Hmm. As we are at this inflection point, and you mentioned data, what do you, in your view, are some of the most important data points to watch right now?
Yeah, historically, I've always liked watching the labor numbers because they are actually hard and concrete. I mean, people without jobs don't buy much. So if jobs numbers are weak, and the problem is we take these snapshots, and it's some of the most reissued data that's out there. I mean, the data that we get on a monthly basis or weekly basis can be changed by hundreds of thousands of jobs in either direction 5 months later. But to the extent that it's accurate, I think the jobs numbers are the ones that indicate what consumers are actually going to do rather than try to measure their mood. I mean, you have all these surveys out there to ask, are you having a good day? Is it sunny? Like, did I just have an ice cream? But if jobs numbers are strong and wages are strong, people are going to, neoclassical economics would tell me a rational man would, behave as if he's confident and spend more money. So I mean, the jobs I think is probably the most direct thing you can take a look at. The difficulty is getting that information in a timely enough manner to really understand where things are at a given moment in time.
Yeah. And is there anything there other than, the non-farm payrolls every month and the initial jobless claims and maybe the jolts that you can point us to? Or
Again, there's nothing that's reliable because, like I said, all of these numbers get reissued so often. But I think if you look at them in aggregate, like if all the jobs numbers, all the jobs data is seeming to coalesce in a direction, then that's relatively, in my opinion, relatively positive for the near term. If that number is negative, in aggregate, no, again, I don't rely on any one number because any one number can get spoofed. But if in aggregate that numbers are weak, yeah, okay, now I'm expecting that things might get a little bit weaker in the near term. But to get any more precise than that and try to trade on a specific data point or a specific news release, that's where you can really cause trouble. It's not what you don't know is going to hurt you; it's what you think you know for sure that just ain't so. I mean, there's that old expression, right?
Hmm.
But again, I don't think you can escape the logic that more people working, making more money is good for the economy. I don't think you can escape that logic.
Yeah. So it doesn't sound like you're particularly concerned about last Friday's non-farms, which came in low and spooked the market for a period of about, 96 hours, but that included a weekend.
Yeah, but if you go back 3 weeks, everybody was worried that the numbers were too strong and we were going to have wage inflation. Like, how quick does it turn? Like, literally, it was 3 weeks ago that I was getting the question about how, the wages were going to continue to drive inflation. We see a slightly weak number. It's like, oh my God, it's over. It's going to zero. But we've done the math. By 2026, nobody will have a job. It's just they just run everything forward in a straight line. So I think that it's necessary to see weaker jobs numbers in order for this to play out. We have to see this. Now, the bigger question is, are jobs going away? Like, is this a trend that's going to continue, or is this just the right amount of medicine and the water is now at room temperature and we can stop dumping ice in the bucket?
Yeah, that is the big question that the Fed has on its hands. Speaking of the Fed, you're calling in from Canada, and the Canada has kind of become an early adopter when it comes to interest rate moves. If I'm not mistaken, they were kind of early on the way up, and they've cut what, twice already? The Bank of Canada has.
Yeah, and we're not doing as well as you guys. Economically speaking, I mean, there's a lot of concern, and again, this has been mitigated recently because the U.S. economic strength has been so strong until the last month or so, where people have begun to see that there's probably a rate cut coming. The fear was that U.S. wasn't going to be cutting rates in September. We were going to have to continue to cut rates. I mean, in Canada, the Canadian consumer is over levered like you can't even imagine. The amount of consumer debt in Canada right now is to choke a horse.
Worse than the U.S.?
Oh,
wow!
By an order of magnitude.
No kidding.
And we're struggling with the mortgage renewals coming due at higher interest rates, and the housing issues that the world is facing are also an issue that Canada is facing as well. So the Canadian economy is not nearly as strong as the U.S. economy. I mean, the only time we really tend to shine is if the commodity markets are really roaring ahead. Then we look really good. Absent that, we struggle. So we're thankful that if I can be selfish, we're thankful you guys are about to take a breath and slow down a little bit. The U.S. Federal Reserve, cutting rates in September, if that is what happens, that'll take some of the pressure off. Because again, from a Canadian perspective, the Fed, the Bank of Canada is going to lower rates or raise rates to try to get inflation under control, lower rates as things get weaker. But at a certain point, it becomes about the exchange rate.
Yeah.
Because you have to keep the exchange rate. You're our largest trading partner. This is the largest trading relationship in the world. So we can only stray so far from U.S. monetary policy. Is at a certain point, then okay, now we're causing trouble because of what's happening with the dollar. So it's one of those ones that it matters within a range, but depending on where you are as to what the priority is to react to. I think the whole world is actually a little bit happy you guys are stumbling a bit. We're happy to see you slow down. You're magnificent, you're amazing, you're beautiful, we love you, but if you guys could cut interest rates a little bit, that'd be nice.
Yeah. Although that love part is maybe a bit of a question there, depending on who you talk to.
And what the topic is.
Indeed. The economy, yeah, sure. But Canada. So, but if you're a commodity exporter, and then a weak currency would help, though, yeah.
Yeah, but all the other stuff we need, it hurts.
Yeah.
So our cars get more expensive, our appliances get more expensive.
Right. That's just dragging on consumer, right? Yeah.
Right. So I mean, it is a closed circle. Like no matter what good news you point to, I'll point to the other side. So it's always about trying to keep that equilibrium, which is a challenge because the reactions tend to be overreactions, late reactions, and overreact and overcorrect, and we just oscillate both sides of normal. You know, if I could just for a second, zoom out for a second, this is one of the reasons that, portfolio management and long-term money management, you can't count on these things. If you've got long-term money, leave it long-term. Trying to pick entry and exit points or understand exactly what's going to happen in the next week or month, man, there's just so much that can go wrong and go sideways. And, that's accepting that chaos a little bit, accepting that, hey, listen, you know what? If the Bank of Canada can't figure out that the inflation is not temporary, it's a permanent thing, and we have to react to it, that's a building full of really smart people who have all the information in the world, and they admit they screwed it up. The average consumer sitting listening to a podcast or reading a newspaper article trying to make a determination that they're going to bet the farm on, that's just a dangerous game.
Yes, it is. Yes, it is. However, it does not stop people from playing it, as we know.
The market for this kind of information far exceeds the supply. So, there's going to be lots of theories that are out there.
The perma bears are a favorite, of course. Anytime there's a drawdown or of any kind, they come out of the woodwork and say that they were right all along.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
And the studies have shown the more outlandish the claim, the more views they get.
Yeah, of course.
There's a direct correlation because apparently oatmeal is killing me because that's a radical thing to say, and that's getting a lot of views right now. So people will say it because that's their business model. So we've firmly entered an age of the finfluencer, and if that's your business, if that's what you're trying to be, the more outlandish your claim and the more emphatic your claim, the more eyeballs you're going to get, and that's the dangerous thing, right? Because then people start really going all in with an entire investment strategy.
I was also going to say there's so few people that actually hold their hold them to account also. People forget.
Well, no. You can pick on the whole market. So last year, I can remember very clearly in 2023, in January 23, the market was pricing in 10 or 12 interest rate cuts. The market, like the whole market, was pricing in 10 to 12 interest rate cuts in 2023. And this year, at the start of this year, it was pricing in 10 plus interest. I mean, again, you can pick on one names, and you and I can go back and forth and do that, but it's the human condition.
Mm,
It really is the human condition.
mm.
The analogy I give to people is like it'd be like reading the Farmer's Almanac, and you read that it's going to be a dry summer, so you decide that you're going to plant only plants that do good in dry weather. That's dangerous. The other guy says, maybe I better keep some extra water around just in case. One's a prudent way to react, and the other is a very, very dangerous way to react. And that's what we're dealing with people trying to make decisions on what's going on right now.
Yeah. It's always better to maybe just set it and forget it, buy index funds and let them ride. But going back to the Fed here, are you anticipating a lot in terms of interest rate cuts? Are we looking at one and done? What's your take there?
Well, I think that the Fed's going to cut. They're going to cut. They're going to talk, and then they're going to run back to their office to see what the market does.
They'll get on their phones. They have to run back to the office.
Oh, sorry.
Otherwise, you're right.
My age is showing. You're right. I was thinking of a desktop, but no, they're just going to pick their phone up and take a look and say, "How did everybody react to what I just said?" And then they're going to come up with their next step, because sometimes they can just use their words and get the market to behave they want. And if they get that, then the job's done and they'll stop moving. So I really think it depends on what the data points are that come out after this, and how the market reacts to it are going to inform it. The dark horse and the scary thing to listen to, and this is happening both in Canada and the US, is the politicization of the Federal Reserve, and that's happening in Canada as well. I mean, the politicians are starting, because this is a huge political issue, is the health of the economy. So I mean, that's kind of the dark horse, and I hope beyond hope that there's no backroom conversations that are affecting things, and that they maintain their independence. But that is a scary conversation that is out there right now that I don't like hearing. And it's not just the US, it's happening in Canada as well.
Yeah, I wonder if in the US you could even do it constitutionally.
Well, again, it's one of those ones that there's the overt, something happens, and then there's behind the scenes what's going on, and you and I aren't in that room.
Right.
We have to have the illusion of independence for sure.
Yeah.
But I think that the Federal Reserves all sit on a very fragile throne. If political, or if public opinion turns too much against what they're doing, then they're going to have a problem. Changes are going to have to happen. I mean, it's almost like they're a doctor prescribing medication, and if the patient doesn't like the medication, even if it's the right thing, the patient can choose to make changes. So that's that. If I don't know what terrifies me at night, the thought that somehow is going to eke its way in. Right now, as near as I can tell, you've got some very smart people using all the information available, trying to make the right decisions, and sometimes being late, but at least showing up to the party with enthusiasm. But no, I don't think that this rate cut indicates we're going to see many more. We could be sitting at the interest rates we belong at. Everybody seems to think that rates are going to go back to where they were. Those are historic lows. Those are generational lows. What makes you think we're going to go back to those interest rates? There's no reversion to the mean that takes us there. This could be where interest rates need to sit.
Yeah.
And you should plan accordingly. And I don't think that's being talked about very much, that this might be the one cut we need and then we're good.
That would be bad for the housing market.
It would maybe properly size it. Like it would, it might be what's going to take to get this back where it belongs. We can't expect to go through the bubble that we saw. Well, bubble might not be the right word. The run up in inflation and the overreaction of it. We can't go through all of that and get back to something that's normal without going through some pain. Now, it sucks if you're the person that is directly affected by it, but it may be what it takes for the overall system to go back to working. We could have let inflation just run, and we would have had that kind of pain. I mean, everybody's complaining about interest rates. It's like, well, we could have left inflation at 8%. Then, yay! Who wins there? This is the kind of pain you have to go through to fix that problem. They have a responsibility. I mean, at the end of the day, they have a responsibility to act in the best interest of people. And if they ever stray too far from that, no matter what the structure is, structures can change.
Indeed.
So you have if you're a leader without any followers, you're just a guy out for a walk. And if you're walking around by yourself, then changes are going to happen whether you want them to or not. Right?
Mm. If you're stumbling around aimlessly in the dark, then I don't know,
Yeah.
that's another metaphor.
Oh no, absolutely. I mean, but some of it is reasonable expectations. Like people expect them to be all knowing. I mean, Ben Bernanke is now serving on the board of PIMCO down in the
Mm.
States, and
Yeah.
they're on record as saying that he's a 60% success rate in predicting Fed moves.
I'm
He had
surprised
the
it's that
job.
high.
He
Mm.
had the job. Now, so if that's where he is, where do you expect the rest of us to be? So,
Yeah, right.
it's they should be reacting to data. You want them to make a change, be thoughtful, read the tea leaves, and take a look at what to do next. You don't want them to put us on a set of railway tracks towards a mountain and hope that the tunnel's done by the time we get there. We want them to react to things.
Yeah.
And but the market, wants to, hey, the prices in all these cuts, and again, there's the market for these kinds of predictions is well in excess of the supply, unfortunately, or
Yeah.
fortunately, it's just the way it is.
Indeed, indeed. So that's why I like to say, do your own research, make your own decisions. Here with Colin White of Verecan Capital. Colin, I want to take a quick break and come back and ask you some more questions about yourself, about how you got involved in investing in the first place, and a few other things. But let's first take a quick break. If you are a premium subscriber, you will not get the break. Do not touch the dial. We'll be right back. In fact, we already are. Everybody else, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Welcome back, everybody. Here with Colin White of Verecan Capital. Colin, this is the segment of the show where we ask our guest to tell us about their origin story, to put things in Marvel terms, how they came to the world of investing in the first place, and then how they became professionals at it. So, yeah, tell us, what's your origin story?
Well, I came out of school as an accountant back in the early 90s. Went to work for a fish company in Nova Scotia. We were running out of fish, so that was a bad place to be. So I quit that and took a job selling life insurance because I got lied to. The guy who recruited me told me a story that just wasn't true, but there was something about giving financial advice that was, I don't know, enthralling, addicting. And I kind of came in the door that way. Did the securities course that same year, so I began to trade and stocks, bonds, and whatnot back in the 90s. So I started giving financial advice before there was an internet. I walked around with a briefcase full of paper and a calculator, big old calculator, fancy one, and gave financial advice. So, I've been at it since the early 90s. So I was there for the tech wreck of 99, 2000 when all that stuff went on, and all of the other things that have gone with the development of the internet. And as we sit here on the threshold of AI, I'm reminded of that journey a little bit. it's been a long ride for sure. But the fundamental underlying, helping people to make good financial decisions, I've always found rewarding. I describe it as a high. You could say a runner's high if you want something that's palatable. I've never been a drug doer, but people who do drugs get really high. I get really high giving advice. You sit down with somebody and you can help them find a way forward, and you get to work with them over 10, 15, 20, 30 years and watch them have success. It's a very, very rewarding career to be in. My accounting background has been nice because I see the world in patterns and numbers, which is useful much of the time. But most of the financial world is dealing with the human condition and how people make decisions, both on their own personal life, but also all the emotions that go with investing. So that's what's proven to be a really great challenge, a rewarding challenge to have through my whole career. So I started as a stock jockey and an insurance salesman way back in the 90s, and both of those professions have progressed, and over the years it's become dramatically different. So it was in the early 2000s or maybe 2010 I kind of reached the decision that one person can't really do the job. They can't really advise somebody. What people need from an advisor can't be given by one person. So I started building out a team of like-minded people I bumped into, I liked, I had arguments with, and I loved having arguments with, and started building out a team. I love a good argument more than almost anything. So we sit here today, and Verecan Capital Management has got 8 offices across Canada, 40 employees, manage close to $1 billion in assets, offer accounting services and mortgages and insurance and investment and financial planning. And as we see our clients struggle with various things, we try to grow our offering. So we began to file tax returns when we saw people struggling to get their tax returns filed. We've gotten involved in the mortgage game where we've seen our clients struggle on the mortgage side. But what we've done is try to take as much of the conflict out of the game as you can. The U.S. is the same as Canada in many ways, is that the financial game is a sales game. So the people you're talking to have a target, and they get paid based on type of product, and they get paid based on volume. And that's where the conflict is. We have these big rule books that they're supposed to protect consumers, but you got a single mom with 2 kids at home and you tell her if she doesn't sell 20 credit cards by the end of the week, she's going to lose her job. You can't be surprised at what she's going to do. So we've organized ourselves that nobody owns a client, nobody's on commission, nobody's on grid, everybody's on a salary. The ownership group gets what's ever left over at the end of the year after all expenses are paid. So at least in the moment, and the person you're talking to, their paycheck that week or that month or even that year is not going to depend on the outcome of the conversation. And that's odd. It takes a really interesting group of people to make that work. It takes a group of people who really are motivated to do the right thing. But there's room for that. There's that business model can work. We bring people over from other institutions. Our most recent hire came from a major Canadian bank, and his job, he has 700 clients he was to look after, but his entire compensation was based on new assets he brought in.
Wow.
How do you serve 700 people and then only get paid on developing them? That system's just broken. And so we've cobbled together a group of people who still have their soul and are trying to do the right thing, still get paid really well, and have a lot of fun working with clients we know we're doing the right thing for. So that's kind of the journey. I don't know, 5 minutes or less.
Yeah. Oh, that's really interesting. Yeah, what you say about the conflict is very interesting too. It's kind of an inherent thing that people have on the financial advisory side.
Yeah, well, there's good people doing good work everywhere, but the people who are doing good work are doing it in spite of the system, not because of the system, right? I've got tremendous friends and tremendous respect for people in every aspect of the industry, but they're doing it in spite of what's around them, not because of it. And the people who truly see the most financial success are the ones who buy into the system. There's been all kinds of documentaries that have been done and court cases, and you guys have had yours just down there with Wells Fargo, I think it was, not that long ago. These things just keep recurring, and they're recurring because the system is flawed. I mean, we had there's an advisor here I was reading about who was brought up on a finding by the regulator because he was, instead of doing switches for clients between investments, he was selling and then buying new investments because he got paid for it. he gets reprimanded, he gets suspended, he gets fined. The institution that has an incentive system in place to make people want to do that isn't even mentioned. If you're going to have a
Wow.
compensation system that is gamed that easily, and you're going to hold individuals responsible instead of the institution, you're missing the mark. You just the poor schmo that got caught doing it isn't the problem. The problem is you have an institution that has a compensation program that incentivizes that. And again, it's the money makes the world go round, and the people who are the most profitable are going to continue to be at the top of the hill and making a lot of the rules. But we feel there's room in the fringes to be different and get known for being different, and find the people out there who are really good people trying to do good things in spite of their environment, and give them an environment where they can actually do it, and see what happens. Bit of a social experiment, the spark that ignites the flame, if you want to steal from Star Wars.
But it's been going on for a while. Your firm has been around for a while, hasn't it?
Yeah, absolutely. Well, I don't know if you're familiar with, it's funny because I take my motivation or interest in different. Brad Katsuyama, who launched the exchange down in the US, the guy that came out with Flash Boys there. So he was the one
Oh yeah.
that discovered, or not discovered's not the word, noticed and talked about high frequency trading. And he went off and founded an exchange that, basically made high frequency trading not a thing. And, you would think that the whole world would want the world to be a better place. You would think that he would be running the largest exchange, on the street. Nope. Well, he's in the fringes doing his thing. He's got some clients. He's making a living. But
Wow.
in spite of the fact he's right, and in spite of the fact that he has a legitimately better way of doing things, the status quo is going to persist because that's the business model. And it's AM radio still in most cars. Just because something better comes along doesn't mean what's there before is going to disappear. I have to believe that I'm on a planet where things are going to gradually get better over time, and you're going to see these changes. I mean, the U.S. actually it was an interesting transition for you guys out at '08 when the RIA structure really kind of blew up. Because in Canada we're still largely an oligopoly. So you get the major five banks control the vast majority of everything. It's more difficult for change to happen up here. I think you guys actually have a much better shot at it down there with the RIA structure taking off. Now, again, there's a lot of money in it, and there's a lot of private equity chasing those firms, but you have a better shot. Like it's fairly tightly controlled up here, and the vested interest of the status quo is in a few hands, and so that's going to make it difficult. But it's fun. Like it's rewarding. I don't stress out when I come to work. I don't stress out at the end of the day, and I enjoy conversations with my clients. That's worth something, and I'll still get paid well for what I do.
Do you have any kind of formula for as far as asset allocation is concerned? Like, the Jack Bogle model is you take your age, subtract that from 100, you put your age percentage into bonds, subtract from 100, but the rest into stocks. And from what people I've talked to seem to have been saying that's going out the window, or has gone out the window. But do you have anything like that?
Shortcuts don't. Sorry, depends what you're comparing it to. If your choice is you're do-it-yourself or you're sitting at home and you want a rule of thumb, it's not the worst rule of thumb.
Mm-hmm.
Because the risk you take if you walk into an institution, you're going to walk into a salesman's office who's going to be trying to sell you something. So the risk of something that's imperfect, maybe not accurate, versus entering into an adversarial relationship where you're being taken advantage of, I'll pick the first one. Now, is that the best way? No. Anything that is set it and forget it, I don't think really works, because we've gone through a 40-year interest rate cycle where mortgage rates went from $22 down to, or 22% down to virtually zero. And we're going to go through another interest rate cycle. So anything you back test over decades is going to be flawed based on the data that's there. I mean, it's just not going to be, it's not going to carry forward. The biggest thing we're fighting against now, and it's really been raveled in the last 5 years, say, is that real estate's always a good investment. It has been because of the interest rate environment over that time period. Yes, your parents did very, very well. Lots of people became millionaires, but it's different now. That belief doesn't hold, and it isn't holding. People are suffering right now. People who pulled out of the market because of either the bad experience or the conflicted relationship with an advisor. They said, screw it, I'm just going to buy real estate. They went all in. They did that entirely. Are now in a lot of pain, many. many situations, right? So you got to be careful about thinking that these rules of thumb that absolutely fit for a period of time, how predictive they are. The right answer, find a good advisor or good third party you can talk to who has some perspective and can take what the world is right now and apply it to your situation. There's no substitute for that. It's very difficult to find, but there's no substitute for it.
No, so hang on. So would you recommend people rent their homes rather than buy them?
See, I think this is a personal choice. I'm renting right
Right.
now.
Yeah.
For me, we just sold the family house. We're not quite sure what we want to do yet. So my wife and I had a conversation. It's like, well, let's try this. We're renting for a little bit. Where you live is a lifestyle choice.
Hmm.
Way more than we did a whole podcast on this because it was funny because I was selling my house and one of our younger associates was buying a house. So I said I owned a house for 17 years and my compounded annual rate of return worked out to be less than the Canadian bond index for the same amount of time.
Wow.
It was okay, but it wasn't gobsmackingly amazing. And I sold ostensibly during a peak in the market. So it doesn't always work out. Now, again, it didn't matter to me because that was the house I raised my kids in. That's what it was. It was a place to raise my kids. It's a nest. We owned it. We made it our own. We did all kinds of renovations to it. We committed to it. But when the kids left, it's like, all right, well, having a big house like this makes no sense. So I'm going to rent for a little while. It wasn't a call on interest rates. It wasn't like interest rates are going to come down. I'm going to get back into the market later. It's a lifestyle choice more than that. In Canada, your principal residence is tax-free. So it does have advantages that, are not immaterial. And yeah, I probably will own something again, but it's not going to be based on where I think interest rates are going to go. It's going to be, yeah, I want to live in this place for the next 10 or 15 years. I want to nest. I want to make it my own. I want to be able to make the changes I want to it. And I don't want to have that transient relationship. That's the planning answer. People trying to make decisions on their house as if it's an investment. You can't sell it, spend it on other things. You need to have a place to live. So it's not a pure investment.
Well, that's an interesting view, though, that real estate is not always a great investment. We should have led the show with that.
Well, you go back to January 2020, for example, and if I told you, like, listen, bonds suck, and let's get into commercial real estate. I can get a portfolio yielding 6.4%. That's just like a bond. Commercial real estate, those guys always pay their bills. That's never gone down. If we had that conversation in January 2020 here, you would have nodded up and down, go, yeah, this is smart. Rich people do this. 2020 didn't work out to be good for that strategy. So that's one of those ones going all in. You unintentionally made your situation more fragile. You can't predict pandemics, but they happen. You can't predict the internet, but it happened. You can't predict what the AI is going to be, but it happens.
Yeah. On the topic of AI, what's your view there? Do you think it's a game changer, or is it just another hype thing?
Again, there's so many parallels between this and the advent of the internet and the advent of computers. There's so many parallels. It's a spectacular tool that we don't understand, and we haven't begun to scratch the surface on how we're willing to use it. Because there's a creepy factor. Like there's certain things that this can be good at. There's certain things we're going to try that we're going to go, oh my God, that's terrible. And the technology is still evolving. It's not done. So, again, internet, you went from dial-up internet to high-speed internet. All of the changes to the technology dramatically changed what you're able to use it for. And trying to predict it, oh my goodness, you sit in rooms with people. I went down to New York to a conference and I was sitting in a bunch of people who are AI specialists, and they were talking about it as an investment. And for them, it was all about the quality of the AI. What's the business case? Where do you make money? I understand, and there's a really valid conversation to have in tech space over what the best AI is going to be. Great, fantastic, I'll give you that. What's the business case? And is it going to just change a profession so that everybody behaves differently, but there's no incremental payoff from that? Like, does it just allow lawyers to do a much better job, but not charge anymore and not really change their profitability? In a market, you would think that, yeah, this is going to come in and raise everybody's game. But in order for someone to get a payoff, they're going to have to get a sustainable advantage over somebody. And the democratization of AI is such that you can download an AI on your own computer and run it. Like, you don't need billions of dollars worth of software to run an AI model. So as long as it stays that democratized, it's just going to improve everybody's game. And trying to guess who's going to profit more or less and who's going to get a sustainable advantage out of this, I think is a really hard question to answer. Who's going to get a sustainable bump from this that nobody else is going to be able to replicate? I don't know what that is, but it's going to be fascinating to watch. And I wake up every morning just to see what the next story is for sure. It's game changing. We're using it. We're piloting now using AI as note taking in meetings. There's doctors in Canada that are using it to do annotated note taking. I think things like that is going to change the world. It's going to change my profitability. And no, because everybody's going to have it. What I do with the extra time, there's a strategic call on a business level that, if I invest that time differently than my competitors, maybe I can gain a little bit of an advantage. But to say that's going to give me some kind of moat around my business that I'm going to have an AI advantage that nobody else has, I don't see that.
Yeah. All right. And where does the name Verecan? What is that? What is that?
I'll give you both stories.
Yes.
You can cut one or use both. It's up to yourself.
Okay.
It's entirely a made-up word because when we set out to try to register every word in the dictionary is basically registered. Every combination of words is registered. And we ended up making a couple of mistakes and learning about intellectual property rights early on. So we basically made up a word. Now, having said that, you look at it, Vera is Latin for true. So you could say we're truly Canadian or very Canadian.
It is Verecan. Yeah.
Yeah. So, it has that connotation to it. But the honest answer is, and I pride myself in being radically transparent, we just had to make something up. And I'm going to give a shout out to Catherine on our team, who was our marketing person, who was the steward that brought this to the table and got us the fancy logo and everything. She did amazing work.
Nice.
But as her and I were talking, Apple used to be a fruit and Amazon used to be a river. Once you come up with a word, it's what you do with it. And, so we're on that journey of trying to do something with it.
Yes, indeed. Very cool. All right, Colin, thanks so much for joining us. Maybe in closing, tell our listeners how they can find out more about you, website and such. I'll put all that information in the show notes as well.
Sure. Verecan.com is the website. Bare Naked Money is our podcast. We have a pod that goes out every second week or so. Varying topics. I would suggest, just check the topics and find one you like, because we try to do very, very different podcasts from week to week, depending on requests. And reach out to us on there if you have further questions.
Very cool. Very cool. Awesome, Colin. Thank you for joining the Contrarian Investor podcast today. Very interesting conversation. Thank you all for listening. And we'll be back here again in a couple of weeks. Speak then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.